Hello and welcome back to another video. My name is Jared, for those of you who don't know me, and I am just a guy who enjoys investing and enjoys making content. Today we're going to be talking about defining your own rules to investing in this video. And if you can do me a huge favor, smash the like button, leave a comment of things that you liked, something along those lines, share with a friend. Everything helps. Subscribe if you want to go back and watch previous videos. Awesome. And let's get into the video. So, defining your own rules to investing. And when I'm talking about defining your own rules, setting your guidelines and making sure you follow them. So, if you only want to hold 20 different funds at any given time, make sure you don't go to 21. Have that self discipline built in and practice it daily, especially when it comes to your investing and your everyday life. So, managing your risk. You're going to have risk to reward in everything that you do, especially when it comes into the investing side of things, which is what we're talking about. And low risk tends to have a less reward. And I'm not talking about 8 to 10% being low, because that's not low. It compounds. It's a beautiful thing. It's great. I'm just talking about if you invest into the S&P 500 ETF, you're not going to be seeing, um, 10x, things along those lines. So you got to balance your risk to reward. Your low risk guaranteed reward is the safer route. That's going to be your ETFs, index funds, mutual funds, your retirement accounts. That's kind of where you want those. So that way, all the money you're putting towards retirement is growing, and you're able to calculate that. It grows on average 8 to 10%. That's following the S&P 500, and you have a greater diversity to it, which means it's a little safer for you. You got high risk, which is going to be when you get into your individual stocks, your crypto investments, individual investments. It's harder to diversify because, once again, you need to set your own rules. You want to make sure that you're doing your own research in order to be able to try to make sure that you're in the right companies at the given time, right? ETFs, they diversify for you. Individual stock, Blockbuster, sorry to say, you probably lost money if you own the company. Individual investments can fail, greater potential to outperform the market. I should actually change that to potential to outperform the market. You don't have a great shot. Most day traders fail, and they don't outperform the S&P 500. And most individual traders, we don't do enough research to be able to back up what we got going on. We just pick from the news, pick from YouTube videos, and hey, Jared said Meta, go buy Meta, and then it goes down 20%, and you just cash out of the market. You never go back, right? And then there's higher risk potential, but you do have a chance at a higher reward. We're going to discuss that a little bit further, but you need to actually start identifying your own risk tolerance. So a lot of people have 40% in ETFs of their portfolio, 40% in individual stocks, and then 20% in income driven, so bonds, something along those lines. It can be different ETFs, just different diversification. Defensive investing. That's going to be what I was talking about with the low risk. That's where you want to have low risk and guaranteed or close to guaranteed. It's nothing's guaranteed in the market, but as close to as possible. And that's going to be your retirement accounts, your ETFs, index funds, mutual funds. 401ks have age accounts, so retire by 40 or 2060, something along those lines. And that is money that is not to be touched, and it's supposed to experience compound growth. Compound growth is a great thing. It does matter. If you guys ever watch The Money Guys, which I'm not affiliated, I just enjoy their content, and I think very good at what they do. They say $1 at 18 invested can equal $88 at time of retirement due to compound growth. And I think that's something that a lot of people really need to have to get to sink in. And the reason why I say that is a dollar saved away today in a bank is going to be a dollar tomorrow. A dollar into the S&P 500 index that compounds at 8 to 10% yearly over 40 years turns into $88. Well, guess what? That about outperforms inflation, and you actually have more money in the long run. When you start talking about, $1,000, then you're talking $88,000, so on and so forth. So all that really matters. The biggest thing that we have on our side is time. So you want to make sure you take full advantage of that, especially in this defensive investing. And then you want to make continuous contributions, meaning maxing your Roth IRA, your traditional IRA, whatever it is for you, for your retirement account, making sure you're getting that employer match in your 401k, so on and so forth. And then we're going to get into the offensive investing. Not offensive as in can't take a joke, but offensive as in offense, defense. And that's going to be your individual investment accounts, non-retirement. And this should only be excess money on top of defensive saving, meaning you have a surplus at the end, you maxed out your Roth, you're close to maxing out your 401k, you got your HSA stocked, you're doing everything you're supposed to be doing, all your bills are paid, all your debt's gone, that kind of deal. And now all of a sudden at the end of the month, you got a few extra $100 that you're willing to put up for a little more risk, possibly a little bit more reward. And that is when you can get, in my opinion, into the individual stock side. And the biggest reason for that is going to be research. You have to do your own research. Do not invest into things that you don't know anything about. Fully research it. Try to become as much of a professional on that company, subject, whatever it is, as possible, so that way you can move forward and you actually know what is happening with them before you actually put your money there, right? You research things before you buy them, I would assume. You look at reviews, things along those lines. It's the same kind of concept, but now you're putting possibly a lot more money into it. Diversification is going to be a huge part of both of these. In defensive investing, you want to make sure that your funds, your ETFs, your mutual funds are not overlapping in a huge way. Meaning you invest into a single fund that 40% of that fund is made up of the Mag 7, which is the top 7 stocks in the United States, which I'm not going to say is a bad thing or a good thing. I'm just saying. And then you invest into a second fund and they are 30% into the Mag 7. Well, now you're overlapping, possibly to a point where you're owning too much of an individual fund for it to be safe or safer, less risky, right? And you want to look into tax incentive accounts such as IRAs, Roth IRAs. I do have a video of Roth versus traditional. It's tax now, tax later. That's essentially what it is. Roth, you pay tax now, you don't pay tax later. Traditional, you actually pay tax, you put it in there, and then you get the tax deferment at the end of the year, and you get some of that money back. But then you pay tax later on. And you always want to DCA in on any of these, meaning into your individual funds, and you want to make sure that you're maintaining that. So if you want to set aside $200 a month for investing, and then just keep throwing it into your couple of funds and make sure they don't overlap. And then you just want to make sure you diversify the investment funds appropriately. And when I say that, I'm talking if you want dividend payers, make sure you're looking at good dividend payers and do your research when it comes to that. Now, offensive is a little bit more of what I'm into, especially with this channel. I want to make some stock call outs, stock prices, predictions, things along those lines. And I have a couple of my rules in here. These are what I do. Once again, everybody should have their own set of rules. These are some of mine. My rule is no more than 5% when investing into an individual stock. Obviously, it can alter. I say that, you invest 5% into Amazon and it goes up 40%. Well, yeah, it may no longer be 5% of your portfolio. I'm talking about initial investment. So if I have $100,000 in my portfolio, then that means the most I'm going to buy into a share, individual share, is going to be $5,000 um, of actual input. Now, that rule is a little newer for me, and so some of mine are a little overweight. I'm working on that. I'm resetting my portfolio. I'm just waiting for the prices to hit of what I'm aiming for with them. Um, so make sure you set your own. This keeps me down to about 20 to 30 investments at any given time. Every investment you need to maintain your research and make sure you're staying up to date with them. Getting more than that is going to be very tricky for you, especially if you're talking about just throwing money every which way. You're not actually going to be able to keep up with the research, watching all the numbers, seeing what they got going on, following the news, checking out all their statements that they put out, and listen to income calls and board meetings and stuff like that. Make sure you do have market diversification. Yes, there is market diversification, especially in individual stocks, and that is going to be across the different markets. So you got the tech sector, different sectors. You got rare earths. You got the um, telecom, healthcare, consumables, all the extras that you have. You got your healthcare kind of things along those lines, makeup, beauty. There's a ton of things, sports apparel. Make sure that you diversify in that fashion as well, and you're not all just tech heavy. um, when I Granted, tech has been kind of controlling the market as of the past, I don't know, 10 years. But regardless, with that being said, it's very easy to go tech heavy because they may have the higher risk or less risk, more reward in the last 5 to 10 years. However, markets can change quickly. And when I say that is it may go to the food industry or energy industry. And now all of a sudden they're all booming up 1 to 200%, and tech is just kind of floating. So you want to make sure that you diversify across all of them so you get to enjoy the ups and then minimize your downs. So make sure you're in the top contenders of each market. I do utilize calls. I do not actively utilize puts. My portfolio is not big enough, in my opinion, to actually hedge for puts or use puts to hedge for my portfolio. I will be interested in that as my portfolio grows, but I do not utilize more than 8% of my overall portfolio into calls, meaning I can have 5 different companies I have calls in, but it can't be more than 8% of my overall portfolio total. And then margin. I don't recommend margin for most people. Go check out some YouTube videos. People have horror stories. They get margined out. Um, they lose most of everything that they got because they decided to use margin and they used it in the bull market instead of when it was down. They just kept seeing green and thought it was going to keep growing forever, right? I do use margin. Um, I can't lie on that one, but I do make sure I'm not over 8 to 10% overall. And currently, I am not trading on margin. I am back to zero on that, to where I am positive on my account now. I do have cash sitting, waiting for more investment opportunities as they arise. That's where I use the margin, as if there's a opportunity too good to pass up kind of deal. And that's gonna be it's a rare oddity for it. Um, so make sure you're using your own guidelines once again and do your research. Watch some of those videos of the people that say do not use margin, and listen to their stories, so that way you have a more greater understanding of margin before you just start accepting money that they're willing to give you for a reason, right? So options, you can use puts to hedge against down markets. As the stock prices go down, you can earn more with it. That's why people use it as a hedge. So if your portfolio is not large enough that you actually need a hedge, then I don't really recommend the puts. Most people are buying puts when the market's already towards the bottom. They think it's going lower, everybody's calling it to go lower, and it's about to shoot right back up. And people are buying puts at that point, and they're losing their money. So, with that being said, also be careful following market trends. The market trends historically happen, they follow one another. It always happens. We are in a V-shaped recovery right now, which is fantastic to see, so don't get me wrong there. But if you follow the market trend, that means technically you should be buying call options right now, but I view that as a risk. Could have been buying call options a few, like last week, and you would have made money. If you bought put options last week, you lost money. So make sure you actually research into all of it before you actually go ahead and start putting your money out there. Calls, I use it in my investment strategy. I use them often. I only purchase tried and true companies. I'm not going out and buying call options on the next greatest hit. Meaning, essentially, when Microsoft first came out, I wouldn't have been buying call options on it. It's just not, it hasn't been around. It wouldn't have been around long enough. Now it's a no brainer. If Microsoft plunges and it's something that I think is just a freak rally to the bottom side, the Bears are winning that day, then I may look into a call option on Microsoft to try to catch it on the way up. It's not recommended for everyone. You do have guaranteed max losses, which is a good thing about calls. You buy a call for $800, the most you can lose is $800. And then you earn more when the share prices go higher. It all comes down to research for me. I'm researching companies that I believe are going to do well. If I'm also researching companies that I think are going to do poorly, then to me that means I didn't do enough research on the companies I'm going to do that I believe are going to do well. I'm a long-term shareholder. That's what I'm striving to be, and that's what I want to be. So I'm researching for the long haul, which also means I'm constantly having to redo research and stay up on everything. Every single company that I own, you gotta constantly be checking the news and see what they got going on. So the investment strategy is, or mine is, research always. And when I'm talking research, news, income statement, growth potential, usefulness, that's a big one. Right now, that's the whole thing with the SaaS. Everybody thinks they're not going to be useful. AI is going to take over. I think they're wrong, but hey, we'll see. Leadership. You want to make sure you got a company with good, solid leadership. You got to check their moat, see their competition, and their momentum. If they're a loser, and they have been for 20 years, chances are they're not going to turn around tomorrow. You just got to kind of read between the lines on some of it, right? Purchase shares at a good evaluation. You'll learn what good evaluations are by doing your research. Don't just buy it because I say I'm buying it. Make sure you're actually looking at the PE ratio and learn how to read an income statement. I have some videos out on some of that. There's a lot of great resources out here on YouTube. Watch the good and the bad. It both have useful insights. When shares are purchased, I continue DCAing in until our upward target is met. So when I say I'm going to buy Amazon, I continue buying Amazon. Just because it goes up 5% doesn't mean I stop. Just because it went down 10% doesn't mean I stop. If it continues going down at a certain point, I may start doubling up on how much I actually buy of Amazon. And once we get to a upwards threshold, I'm going to start setting stop losses, um, which is another portion of my investment strategy. When I am positive on something, I don't want to give away the profits, so I'll start setting stop losses. If it's a company that I really believe in, I may not stop loss all of my shares, just a portion. If shares go to severe undervaluation, I look at call options of said shares. AMD is an example. I own, I think, 6 more call options on AMD. I just posted a video of me showing that I sold a couple. AMD, I've been buying for a while now. I've been DCAing in. I got my dollar cost average down, and when it was under 200, I was looking at call options. It's just one of those things. The only way I can really see it in the next year is up, so I bought a few long calls. It's not for everybody. It's just what works for me after doing my own research into AMD and seeing the potential. That's what I felt was right for my own portfolio. If call options go positive, I begin offloading. I don't hold them forever, especially if I start hitting 100% gain on it. So essentially double my money. If I double my money, I sell half. Now I'm risk free. Hold on to it for a little bit longer, see if it's going up, going down, see where the momentum is. I don't want to wait until the last week and get stuck with worthless options. And the most important thing of this video, if you gain anything from it at all outside of research, it's important. It was the first word on this page in the paragraph portion, not the title. I understand. But sell your losers. If they are a loser and there's no opportunity for you to get your money back, use that money somewhere else that has more potential. Hopefully you guys learned something from the video. I hope everybody has a great evening, and I hope everybody's working on their portfolio, working on their own strategies. It's really important, and I think it will help you in your future and your own investment journey. Once again, my name's Jared. If you enjoyed the video, smash the like button, helps out a lot, and I will see you in the next video.